What are dividends? Most investors love them, but here is something interesting. Warren Buffett's company, Berkshire Hathaway, has never paid a dividend, ever. So, why do some companies pay dividends while others don't? Are dividends actually good or bad for your returns? And where you can find dividend-paying stocks? In the next 9 minutes, I'll answer all these questions. Stay with me until the end to get the most out of this video. First, let's make one thing clear. When you buy a company's stock, you become a part owner of that company. Since you own part of the company, you own part of its profits too. A dividend is simply the company paying out some of those profits to you in cash. Now, here is where most people get it wrong. Dividends are not a reward or a bonus. This is your money. You already own it. The company is just giving it to you in cash. Once you get your dividend, you can spend it, save it, buy more shares, or invest it somewhere else. Companies typically pay dividends on a regular schedule, usually every quarter, though some pay monthly or annually. Let's say you own 100 shares of a company and they announce a dividend of 50 cents per share. You'll receive $50 in cash deposited directly into your brokerage account. It's that simple. Now let's answer an important question. Why do companies pay dividends? When a company makes a profit, it ends up with extra cash at the end of the year. Management then has to decide what to do with that money. Some of it might be reinvested back into the business, for example to buy new machines, improve production, or expand operations. Another portion might be invested in other assets, like bonds or short-term investments. The company may also keep some cash as a reserve for future needs. Sometimes the company might use the extra money to buy back its own shares, which increases the value of the remaining ones. And if there aren't enough opportunities to reinvest profits at a high return, the company may choose to distribute part of its profits to shareholders as dividends. Regular dividends are often seen by income investors as a sign of stability, proof that the company generates consistent cash flow. However, as we will see, this doesn't necessarily mean it's the best use of that cash. And that leads to the next question. Why has Warren Buffett's Berkshire Hathaway never paid a dividend? The answer is simple. Warren Buffett is probably the best investor in the world. When Berkshire Hathaway earns a profit, that extra cash is managed by Warren Buffett and his team. They look for the best investment opportunities, and because of their skill and experience, they can earn higher returns than most individual investors could on their own. If the company returned that cash as dividends, you will have to find good investment opportunities yourself, which is very hard. Plus, dividends are taxed, reducing your effective return. Most investors would likely settle for an index fund, earning around 10% per year at best. By keeping the cash inside Berkshire, Buffett can compound it at a higher rate, and you don't pay taxes until you sell your shares. And that's exactly why Buffett does it. He is focused on what is best for his shareholders in the long run. But here is the reality. Most companies aren't Berkshire Hathaway, and most CEOs aren't Warren Buffett. If a company doesn't have exceptional investment opportunities or brilliant management, returning cash as dividends might actually be the best choice. To sum up, while many investors love dividend-paying stocks, receiving dividends isn't always in their best interest. So when do dividends actually make sense? If you are retired or close to retirement and need regular income to cover your expenses, dividends are perfect. They provide steady cash flow without forcing you to sell your shares. If you are a conservative investor who values stability over maximum growth, dividend-paying companies tend to be more mature and less volatile. And if you simply prefer seeing cash hit your account every few months rather than waiting years for your investment to grow, dividends give you that psychological satisfaction. But if you are young and investing for long-term growth, dividends might actually slow you down. Every time you get a dividend, you usually have to pay taxes on it right away. For example, in Greece, the tax rate is 5% now. In the US, it can be anywhere from 0% to 20%, depending on how much you earn. And in the UK, it ranges from about 9% to almost 40%. So taxes reduce the cash you actually get from your dividend. Money that leaves the company gets taxed, and now you have to figure out where to reinvest it. If the company had kept that cash and reinvested it for you, it could have kept growing tax-free. Plus, unless you are an expert investor, the company probably has better investment opportunities than you do. This is why growth-focused investors often avoid dividend stocks entirely. Now let me show you the actual numbers behind dividend investing so you can see exactly how much you could earn over time. Say you invest $5,000 and buy 50 shares of a company at $100 each. The company pays you $1 per share every 3 months. So every quarter you get $50 in cash. That's $200 per year, a 4% dividend yield. Now let's say you hold for 10 years and reinvest every dividend to buy more shares. If the stock price grows 5% per year, a reasonable average for a stable dividend stock, it will be worth about $163 after 10 years. Here is what happens. As the price rises each year, your dividends buy fewer and fewer shares. After 10 years, you will own about 67 shares instead of your original 50. At $163 per share, those 67 shares are worth about $11,000, more than double your original $5,000 investment. Plus, you are now earning $268 per year in dividends instead of $200. And remember, you didn't add a single extra dollar after that initial $5,000 investment. This is the power of compounding. Your dividends buy more shares. Those shares generate more dividends, and the share price grows over time. As Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So, where do you actually find dividend information? A great option is Yahoo Finance. It is completely free, has a website and an app, and it is packed with information. I use it all the time. Just type in the company name or stock ticker and you'll find everything. How much they pay, when they pay, and their dividend history going back years. Now, the most important number you need to understand is the dividend yield. This tells you how much income you are getting relative to the stock price. Here is how it works. If a stock costs $100 and pays $4 per year in dividends, that's a 4% dividend yield. You calculate it by dividing the annual dividend by the stock price. You should also check how long the company has been paying dividends consistently. Some companies have paid dividends for 10, 25, or even 50 years straight. That's a good sign of stability. You can find this information on the company's own website in the Investor Relations section. Most companies are proud of their dividend history and display it prominently. For example, Coca-Cola has paid dividends consistently for over 60 years, and its payouts have steadily grown over time. Let's say that you invested $5,000 in Coca-Cola back in 1962. If you kept reinvesting the dividends every year, that $5,000 will now be worth $1.65 million. That's 330 times your money, or a 33,000% return. Impressive, right? That's the power of compounding and investing. So, if you want to learn how to spot these opportunities yourself and watch your money grow, hit that subscribe button right now, because in this channel, I break down value investing step by step to help you become a better investor. If you are new here, start with my video on how to analyze a balance sheet. It is the foundation of everything. Click the link now to start your investing journey, and I'll see you in the next video.